Short-term or long-term? Whenever CFDs are discussed, the question of whether they are only suitable for short-term trading is bound to come up. CFDs are particularly suited to short-term trading. That's because they let you deal stocks in small sizes in a cost-efficient way. The leverage magnifies your potential return on capital. Common wisdom has it that you shouldn't use a CFD if you are planning to hold a position for the long haul. CFDs are traded on margin, so you pay or receive an overnight financial rate linked to the London Interbank offered rate. That's LIBOR for short. This means that you can keep them running for as long as you choose, but in practice, CFDs are best used for the stock markets if used under around 10 weeks. That's roughly where CFD financing charges exceed the stamp duty charge for stocks. On the face of it, this seems to make sense. If you want to invest your money for the long term, you should buy something which doesn't need a continual maintenance charge. However, you can figure this expense into your profit calculations and still make it worthwhile. A CFD is a leveraged product, so if you take a long position and your research and instincts are correct, you can profit handsomely compared with your initial outlay. You can open a position and only pay 10% of the underlying security's value up front. If the value goes up even 1% per month, that would be 12% per year before compounding. That would more than pay for the interest. Of course, trading CFDs in the short term is a great way of making money. But just because you're using them in the short-term context, don't overlook them when you're considering your long-term trading objectives.